Every year, the Internal Revenue Service adjusts the earnings amounts for each of the tax brackets to account for inflation during the year. Fortunately for American households, the pace of price rises has slowed, which means that the adjustment of the tax brackets won't be as high as the 7.1% increase for the 2023 tax year. The IRS has yet to release the official figures for the 2024 tax year, but Bloomberg Tax and Accounting has put out its historically accurate tax rate projections for what to expect. According to their analysis, the tax bracket amounts will increase by 5.4% for taxable income next year. The adjustment will apply to the 7 federal tax brackets as well, the standard deduction that taxpayers can claim when filing. Here's a look at what has changed for 2024. The 7 brackets remain the same next year at 10%, 12%, 22%, 24%, 32%, 35%, and 37%, which were set after the 2017 Tax Cuts and Jobs Act. These will be in place through the 2025 fiscal year, after which time, with no congressional action, the tax rate will increase for all except the lowest. The income thresholds for tax brackets are adjusted to reflect inflation or the cost of living. This is based on the Chained Consumer Price Index created by the Bureau of Labor Statistics through continuously tracking the changing price of a basket of goods and consumer purchasing behavior in response to that change. The annual adjustment is designed to avoid bracket creep when people are pushed into a higher income bracket or inflation reduces the value of other deductions or credits. So, for example, instead of 10% being applied to the first $11,000 of income as in 2023, it will now be applied to the first $11,600 for taxpayer filing individually in 2024, according to the projections. The standard deduction will increase in 2024 by $750 to $14,600 for single filer or married but filing separately, by $1,100 to $21,900 for head of households, and $1,500 to $29,200 for married taxpayers filing jointly. An additional standard deduction of $1,950 will apply to those who are either 65 and older or blind, and the amount doubles if both apply to a taxpayer in 2024. Dependents that can be claimed on another person's tax return for the 2023 fiscal year are limited to a standard deduction of either $1,300 or your earned income plus $450, whichever is greater. However, the total can't exceed the basic standard deduction for your filing status. Your filing status could save you extra money. There are 5 categories of filers, and conditions apply to the one you should use to file your taxes. The main determiner is your marital status on December 31st of the year for which you are reporting taxes. That will be the one you use for the entire year. It's possible that more than one filing status applies to you, so the IRS recommends that you use the filing status that will reduce your tax liability the most. Here are the 5 U.S. filing statuses. Single. For those who are not married, divorced, or legally separated. Married filing jointly. Married couples can choose to file a joint tax return. Widowers can also use this in the year their spouse died. Married filing separately. MFS. Married couples also have the choice of filing separately if it is more financially beneficial. Head of household, HOH. The IRS cautions not to choose this by mistake, and special rules apply to qualify for this filing status. Generally, this status applies if you are not married and must have paid more than half the cost of keeping up a home for yourself and a qualifying person. Qualifying widower with dependent child. This status is similar to married filing jointly. It is applicable for only 2 years and conditions apply. To help taxpayers determine which filing status applies to them, the IRS has an online tool called What is My Filing Status? Income taxes are progressive. The tax brackets are progressive. So if you file as a single filer and have a taxable income of $50,000, you don't pay 22% on the whole of your taxable income. You would pay 10% on the first $11,600, $1,160, 12% on the income between $11,600 and $47,150, $4,266, and then 22% on the remaining $2,850, $627, for a total of $6,053.00 as opposed to $11,000. That amount is $254.50 less than you would be taxed for the same income in 2023. For more information, or to better understand what your retirement plan could look like, take the questionnaire linked in the video description.